I guess my big prediction for business losers this year were asset classes that were highly dependent on liquidity. You guys predicted crypto would be one of those. Clearly, it's taken a massive hit. Have you seen how much the crypto markets are off just in the last week? So,
will the haircut that we've all taken in the public markets spill into the privates? And
it's starting. It's starting.
But it feels to me, it's not just about what's going to happen with new emerging growth companies. But I mean, you guys correct me if I'm wrong, but there are hundreds of companies that have raised billions of dollars at valuations that if they look in the public markets now, they are never actually going to achieve if they were to go public in the next 3, 4, 5 years based on their projections.
So to your point,
so
there are there are 900 unicorns right now, 900. And so once you get to, look, it's one thing to be a $200 million company and sell to Microsoft or whatever. But when you're a $1 billion company, there are very few buyers.
And I just want to point out there's a huge disincentive for an investor or a shareholder of VC or a private equity firm to take a big write down on a company like that. And so there is always this push to what do we do next? And it creates this certainly,
I can tell you, yeah.
I'd love your point of view, but this really like unhealthy tension, because to take a write down on 900 unicorns is going to cause a write down of hundreds of billions of dollars across all VC portfolios in aggregate. Because they're not going to end up going public at,
sorry, just to finish your thought, because the end market is only to go public. There are very few companies.
There are no M&A exits. Yeah.
There are no, and not in the billions of dollars, because you have to think
one or two.
Big tech is off the sidelines. Okay. Yeah. You know, even if you look at like Visa and MasterCard,
they're not going to be allowed to do big deals.
Nobody's allowed to buy these big companies.
There'll be mid-tier M&A. I have an example that I can tell you.
Mid-tier maybe, but my point is when you have 900 companies worth $1 billion and plus,
they have to go public.
They have to go public. And so
correct.
You can't go public into a valuation framework that values you at 30 to 40% less of your last private mark.
Right.
Yeah.
That doesn't work.
You did have...
Or do you, Chamath?
You right? actually do.
So this is an important question, because isn't that going to be the case that all these VCs with the 2015, 2016, 2017, 2018, 2019 vintage are going to end up having, they've all got these great marked books right now. You know, the books are all marked to 3x, multiple on invested capital. And now they're going to end up having these liquidity events that are going to come in at shockingly low valuations. And there's going to be this great write down and retrenchment.
I can tell you there's a couple of examples. One is The Athletic yesterday, which had raised money at $500 million just 2 years ago. Just sold for about $500 million to the New York Times. And those investors basically put money in and they got their money back. It's a push. So I think you're going to see a lot of these pushes.
Point.
No, I'm agreeing with you. Yes, I'm going to give you the examples. Then there's also
mid-tier acquisition by a mid-tier acquirer.
And so there'll be plenty of those that occur. So there'll be a lot of pushes, I think, is my prediction of those 900 unicorns. And then for a lot of these SaaS companies...
So you're saying you think that a bunch of them are going to sell for under $1 billion, and the VCs, because they have preference, they're going to get their money back.
Correct. I think it's going to be a lot of these pushes where, I don't know, what is it in blackjack, David, when you're playing those three hands and you get a push? And it's like, okay, I'm going to live to fight another hand, now which we've seen Saks do a number of times. And then for the SaaS is where Saks, I'm interested in your position, because we saw in SaaS, all of a sudden the private market, 30, 40, 50, 60, 70 times top line. And now it's gone back down to 20, 30, 40. So those companies now basically have three.
The public markets have, but I don't think the private markets have.
In the private markets, it has happened already. Everybody's pausing. And so for the people who raised that 50x, congratulations, you did the right thing. If you have enough money to fill in that valuation.
Is it a congratulations though? I mean, it seems like they're in a pretty tough position now. You just raised money at $1 billion valuation with 10 million of revenue. You're like,
or 20, let's say 20 would be the more likely.
I mean, like, what are you going to do? What are you going to do in your next round? Because you're burning 100 million a year now, or 40 million, or whatever it is you're burning.
Almost all the companies I've seen in this exact situation you're talking about have that 20 million. They got $1 billion. They raised 100 million or 200 million. And they're basically now saying, okay, we got to make this last until we can catch up to that valuation and get to 50 to 75 million. So I think I would take that deal as a founder and as an investor, because it takes out the downside, and now you just have to worry about catching up to the valuation, and you have 4 years of runway. They're not going to right-size the spending.
No. Those companies do not. Those companies absolutely do not have 4 years of runway. I will bet dollars to donuts they have 2 years or less, and most of these companies have 18 months.
Which means they got to be raising in 6 to 9.
No, they're changing. They're changing their spend, and they're changing their targets.
How are they changing their spend? They're not firing anybody. You're not hearing about layoffs at startups.
Okay, all right. You're not hearing about it, but maybe they're changing their forward-looking growth plans. What are you seeing, Sachs? I'm telling you what I'm seeing. What are you seeing, Sachs?
I think that the trickle-down effect is inevitable, but I'm not sure it's fully kicked in yet. It's going to take a few high-profile deals to land at, say, 50 times ARR instead of 100 times ARR in order for everybody to know that there's a new valuation level. So if you look at the altimeter chart on public SaaS multiples, let's see. I mean, Nick can pull it up. It's the SaaS index. It shows median expected value to next 12 months revenue. And during this sort of late 2020, early 21 period, it got as high as about 15 times the historical
next
average.
Year.
Yeah, for next 12 months revenue. Which is sort of, that kind of makes sense. So historically it's around 8, right? So basically all the valuation levels doubled and now they've come down to about 10 times. So you could say that if it fully reverts to the mean, we still got like another negative 20% to go. I don't know if that's going to happen. I mean, I think there has been a greater recognition that SaaS businesses are some of the best businesses to own, right? They are subscription software businesses, great gross margins. They just keep compounding. So maybe it will stabilize at 10 times. But I think what we can say with 2020 hindsight is that the record price levels we got to in the public markets in 20 and 21 were sort of unusual and unique, and probably the result of this incredibly expansionary fiscal and monetary policy that was coming out of Washington. Now, has it trickled down to again, VC markets yet? I mean, the way that has to happen is that the latest stage investors, the crossover investors who invest in both public markets and private markets, they have to start paying less for the latest stage growth companies. And then, all the downstream VCs are going to start paying less as well because, if the markups are lower, you have to take that into account. So look, all of this is underway right now. I mean, I gave a Bloomberg interview in December, and I think I went on Maria Bartiromo's show around that time as well, and I kind of warned that all of this was coming. And we're in the midst of a giant re-rating because we're realizing that so much of the peak values we were seeing in 2020 and 21 were the result of artificial liquidity. And it's what you guys predicted. It's one of our big, I guess my big prediction for business losers this year were asset classes that were highly dependent on liquidity. You guys predicted crypto would be one of those. Clearly, it's taken a massive hit. Have you seen how much the crypto markets are off just in the last week? So it's
so much for them being uncorrelated.
No, it's highly correlated. Look, the crypto markets.
Bitcoin's going to be uncorrelated, so the market's going to go down.
The crypto markets are like a sponge for liquidity, and the more liquidity there is out there, the more money can flow into a more speculative asset class. But look, my objection to this, is that if you look at the Fed's actions, I think Chamath is right that they waited way too long to react. And during the crisis, they overreacted. They pumped. We on a previous pod, we showed the assets.
They vacillate between underreaction and overreaction.
Yes, exactly. Yeah. And now they're going into overreacting again.
Yep.
I actually think they nailed it. In mid-December, they nailed it by giving us business certainty around what the new rate environment was going to be. And just 3 weeks later, in the minutes to that very meeting, they completely undermined the certainty or the greater level of certainty and predictability that they had provided markets. They've now introduced massive uncertainty. So it's unbelievable.
It's like they're pilots and they stalled the plane and then they're like, oh, let's pull back.
Well, no,
stall it some more.
They're kind of pulling out the manual and learning in real time.
Yeah. And it's like, you need to just point the nose down a bit and add a little bit of speed so you get some lift. It really is tragic.
The performance of our government at every level since COVID at the last, since 2020, it's been abysmal. First you have the self-inflicted wound of lockdowns. The economy was going to take a hit no matter what because highly at-risk people would have stayed home and reduced their economic activity. But instead of just protecting the at-risk people, we had to lock down the entire economy. We padlocked Elon's factories and on and on. So we basically shut down the whole economy for no reason. And states like California kept it going way longer than they had to. So then the government just prints like 5-6 trillion and the Fed doubles the size of its balance sheet. And
Overnight.
then now they're abruptly getting off drugs. I mean, look, they put us on drugs and now they're going cold turkey. And so I think there's actually like a much greater risk now of the economy going into recession this year because of the Fed's overreaction this week. I mean, they had the Goldilocks scenario down about 3 weeks ago, and I think they're going to tank the thing now, or there's a much greater risk of that.